Thanks for checking out my video. Quick announcement, there will be no video for the next weekend, so I will try to cover as much as I can in this video. Okay, so the US stock market had a solid week to welcome Trump's return to the White House. Before last Friday's decline, major indexes were on a 4-day winning streak. All three major indexes posted their second straight positive week, with S&P 500 hitting its first record close of 2025, signaling that the bull market is back in full force after December's pullback. So far, the Wall Street has reacted to almost every statement made by President Trump, even those that should not have any impact. This shows that the market has not quite settled into their pace. This also shows how volatile the market can be. Well, we were only first week into Trump administration. More to come in the weeks and months ahead, which I will discuss a bit more in this video. Do watch till the end to find out more, right? Okay, the first week of the second Trump era was a great one, though it ended with profit taking and all the major indexes in the red. But despite Friday's retreat, excitement towards Trump's pro-business policies has largely pushed the stock market higher last week as investors focused on his return to the White House. Wall Street was relieved that there have only been threats on the tariff front from President Trump instead of actual action, at least for now. In addition, Trump's call for cuts to US interest rates, oil prices, and taxes have further lifted market sentiment. And last but not least, the first wave of corporate earnings displayed largely strong performances, which contributed to the positive mood in the market. With so many good news in place, the S&P 500 climbed to a new record high last week, erasing December's market pullback. A number of mega-cap tech stocks were the main driver behind the market surge to all-time highs, as major indexes closed out a second straight winning week. Alright, a key test is looming this coming week with big tech companies set to report their quarterly results. This is probably the reason why we had a bit of market weakness last Friday as investors locked in some profits ahead of a major earnings week. The notable tech heavyweights that are scheduled to report their earnings results this week are Microsoft, Meta, Tesla, and Apple. They are going to put the latest rally to test. With 2025 well underway and AI still the hottest topic in town, one can expect plenty of presentations and conversations about how companies are monetizing the AI-related technologies and how much they are investing and spending on capital expenditures relating to constructing data centers and producing new AI models. But whether all this would excite investors or not is quite difficult to guess. On another note, attention will also be on the Federal Reserve meeting on 28 and 29 January. According to CME Fed Watch 2, the market is pricing in about 98% probability of a pause in rate cut this month. It will be interesting to see how the market reacts, especially when Donald Trump just demanded the interest rates to be lower. And in case you're not aware, Chairman Jerome Powell is set to announce the central bank's latest policy decision on the second day of the meeting, which is Wednesday 29 January. The market will also be keen to hear more from him during the post-FOMC meeting press conference. Okay, moving over to the next segment, technical analysis. Like I have shared in my past videos, the bull run is still very much intact despite the pullback in December. As you can see, the broader market index, SPY, had climbed 6% from its low of 575 to a record high of 610 in less than 2 weeks, with 3 bullish gap ups. So now the question would be, what's next? Okay, typically when an index or a stock hit a record high, sellers tend to dry up temporarily because everyone would want to let their winner run a bit longer. If I were to use the Fibonacci extension level as a gauge, barring any unforeseen negative event, the broader market could still have further room to run up till probably around 616 before hitting the next resistance. Whether it can run till this level, it really depends on the earnings results from the various mega-cap companies, which are going to take place this and next week. If let's say the earnings disappoint and the market decides to fall, watch for 600 as the first level of support. Other than being a psychological level, it is also where the first Fibonacci retracement level is. But to me, the important level lies at around 594. That's where the next Fibonacci level and the 50 moving average are. It's also where the gap sits. If SPY somehow drops below the 50 moving average these 2 weeks, I will be on the lookout to see if there are any discounted shares to buy. Reason being, since November 2023, whenever SPY fell below the 50 moving average, it rebounded shortly after, which has proven to be a good opportunity to pick up shares. The most recent time was in early January. Even if you haven't been able to pick the bottom, let's say you entered when SPY was in the 580s range, you are already up about 5% in less than a month. Alright, let's now check out Apple's chart. The analysis for Apple is kinda straightforward, especially when you have this downtrend channel being drawn out. Viewers can try to draw it too, it's quite simple. As you can see, Apple is stuck in this downtrend channel, which means the short-term trend is still bearish. I recorded a few videos ago, I shared that Apple's parabolic run-up towards the end of last year was not sustainable without new updates on their fundamentals. And it could be Apple buying back their shares, which helped to push the price higher. The buyback could be my speculation, but one thing for sure that turned out as I have expected is indeed the run-up was really not sustainable, as Apple fell significantly since the start of 2025. Okay, why do I say the chart is straightforward? In terms of the bearish thesis, as long as Apple stays in this downtrend channel, it is bearish. Worse still, if it falls below the channel and below the 200 moving average, we could see a waterfall in the share price. I think the only possible cause of such move would be a disappointing earnings or forecast on 30th January. So, if Apple breaks below the downtrend channel, we could see it touching 215 at least. That's where a mini support is. But I wouldn't put much emphasis on that because honestly, if Apple's earnings disappoint, I believe it could fall below 210, probably hit the 123.6 Fibonacci retracement level. If Apple were to hit this level, it means the share price would have fallen about 19.6%. That's almost equivalent to a crash in the share price. In case you are not aware, the definition of a crash is 20% drop from its peak. Okay, here's a potential saving grace. Apple's share price has been very beaten down and a number of negative news had come out over the last 1 month or so. Therefore, I wouldn't be surprised if Apple's earnings ain't that great, but the share price goes up because the negative news have been baked in. Furthermore, the RSI has been floating at the oversold level for a while already, and a technical rebound is always on the card. But that said, a bounce could be a dead cat bounce, which means the market makers may bring up the share price to cool off the indicators before dumping again. On the other hand, for Apple to regain a bit of bullish momentum, it needs to at least break out and break above the downtrend channel. But for better signal of a reversal of this bearish trend, we would want to see Apple going above that blue resistance line that I drew at around 237. Alright, moving over to Tesla. Well, Tesla's price movement looks stagnant to me as it traded sideways last week, moving between this tight range of around 406 to roughly 433. I know you might think, how is this a tight range? More like a wide range. But this is Tesla. The share price can move within a 20-point range in just one single day. Anyway, this coming week is a huge week for Tesla as the company is set to report its earnings on 29 January, Wednesday. Based on 2024's data, the share price has been very volatile one day after the earnings date, with a minimum of 12% movement. The last time round, Tesla's share price rocketed nearly 22%. Amazing. According to this website Options AI, the expected move for the upcoming earnings is around 8.7%. Let's round it up to 9%, which means we can expect to see Tesla at either 440s range or 360s range. Okay, let's first talk about the upside. If Tesla's earnings or forecast impress investors, and if the market makers want to bring the share price up to 440s range, I believe the follow-through bullish momentum could further bring Tesla to 460s range a few days after the earnings. A more meaningful resistance will come at around the record high area, which is the 480s range. If Tesla couldn't break above the record high at the first instance, I would expect it to chop around that range, and it is just a matter of time it punches above 488 and go into 490s range or even hitting 500. Okay, that's for the bullish thesis. In terms of the bearish thesis, just a very quick one. If you would like to support this channel and at the same time looking for a new low-cost brokerage account, do consider signing up either Longbridge or Tiger using my referral links. They have their own respective sign-up rewards, so feel free to check it out on their website for more details. To be transparent, I do get referral fees if you sign up using my links. Just to share, I recently signed up for Longbridge account, fulfilled its sign-up rewards criteria, and I got myself a free Nvidia stock, which is worth 142 US dollars now, around 190 Singapore dollars. Okay, sorry, back to the bearish thesis of Tesla. As shared earlier, if things go wrong on the earnings day, a potential 9% downside will see Tesla falling to 360s range. Alright, sharing my unpopular opinion, if the market decides to dump, I am actually expecting the share price to go even lower to 350s range. Let's use 355 as a gauge. From the current price to 355, that's around 12.5% drop. Will it happen? I honestly don't know. But if the next direction is towards the downside, I am of the view that the probability of hitting this level is pretty decent. In fact, I have shared this a few videos ago. But of course, if the market likes the earnings and Tesla share price pops, then my bearish thesis will be invalidated. Okay, let's have a look at Google's chart. Just like what I have updated in the previous two videos, Google is still in a consolidation stage as it continued to move between 187 and 201. But this time round, there is a small difference. Basically, there were two bullish signals. The first one is that the MACD had confirmed a bullish cross last Friday. The second signal is Google had finally managed to close above the huge 200 level. As shared previously, Google went to these 200-201 levels on 3 previous occasions during intraday, but each time it could not close above 200 when the trading sessions ended. And so we have finally achieved this feat. Therefore, Google is leaning bullish right now. But relax, don't get too excited yet. That's the only first step towards a breakout. For confirmation, we need Google to stay and close above 200 for another maybe 2 days. If that happens, then yes, it's very bullish, and we could see a breakout as well as new record highs, multiple record highs actually. Sellers will also likely dry up till at least the earnings day on 4th February. As for post-earnings day, it's anyone's guess in terms of the direction because it all depends on whether the market likes their earnings or not. Okay, on the other hand, if Google couldn't hold this 200 level either this or next week, the downside can be massive because I'm expecting the bears to bring Google to the bottom of this consolidation zone, which means around 187. If we hit this 187 level in the next 2 weeks, don't worry yet, because this level presents a decent support. I mean, you can see on the chart that Google bounced off this level a few times previously. It is only when Google falls below 187 then I will be on alert to maybe pick up shares or to sell put options. Both are bullish moves. Okay, next up, let's check out Meta's chart. Meta is the classic example of what I have shared earlier. At all-time high, sellers typically tend to dry up a little bit. As you can see, the previous record high was around 638, and the moment Meta went above it, it continued to climb higher and higher towards 650s range with the huge solid green candle. Alright, so what's next? Just to highlight, based on the Fibonacci extension level, there is a resistance at 651, which probably explains why the share price pulled back after briefly touching 652 last Friday. For this upcoming week, I would expect this 651 to continue to act as a resistance. But honestly, at record high level, any form of resistance is a new and unproven resistance level. In other words, bulls can bring them above the resistance easily, and we really wouldn't know when the market makers start stepping in to sell their shares to take profits, which means at all-time high level or near all-time high area, I wouldn't take on any bearish trades. As for the downside, I believe the 627 to 632 area will provide a temporary decent support. This is the area which Meta had a bit of difficulty going above previously. In other words, it has turned from an area of resistance to area of support. If this area breaks, don't be too surprised if Meta slides towards 600 where the 50% Fibonacci retracement level is. This is a common rebound level. Okay, at the end of the day, so long as Meta doesn't fall below 588, I think we are all good, because 588 is the bottom of this consolidation zone. So if 588 breaks, there is then a high probability for Meta to waterfall towards 550's range. Moving over to Microsoft, in my last video I shared a few bullish signals on Microsoft chart. Feel free to check out that video. I also mentioned that if we have a bullish cross on the MACD, I would expect Microsoft to fill the gap between 435 and 436. And Microsoft really had a bullish week. I'm glad that I took on the bullish option trade at the start of January. Just to add on, I also specifically mentioned to watch 444 as the final hurdle for Microsoft to overcome. Lo and behold, look at where Microsoft is now, 444. Okay, so for this week, this 444 continues to be a key level to watch for the bulls. We need more green candles above this level before we can see another all-time high. Anyway, Microsoft is going to report their earnings on 29 January, Wednesday. If investors like their performance, and with a solid close above 444, I do think it's almost certain we will go near or even break that all-time high at 456. On the other hand, if their earnings disappoint, there is then a high probability that Microsoft will fill that big gap between 431 to 436. At the gap area, pay very special attention to two things. One is the green uptrend line, the other is the 50% Fibonacci level at 430. By the way, 430 is also where the 50 moving average sits. Therefore, if Microsoft goes below these levels, please expect 424 to be tested too. That's where the most critical Fibonacci level is, as well as the strong 200 moving average sits. And if the 200 moving average gets breached as well, I will be excited. Just to recap, I stepped in to buy some Microsoft shares and sold a put option when it fell below the 200 moving average during the first half of January. I might do that again if it happens again. Okay, let's now have a look at Nvidia's chart. For Nvidia, I must say it's actually quite a volatile stock, pretty comparable to Tesla. I mean, from early November till last week, there were at least 15 occasions where Nvidia share price moved up or down more than 3% in a single day. So if you're a new trader trying to trade Nvidia, please exercise caution. Anyway, after closing above 140 last week, I thought Nvidia would at least hit 150. I was wrong. It only went to around 149 before printing that big red candle on Friday. That's called a bearish engulfing candle, which, as the name suggests, is bearish. Okay, but a single candlestick doesn't shape a trend, so I would only say Nvidia is bearish if it falls below 140 again. Why 140? Because that's where the 50 moving average is, as well as where the common rebound Fibonacci level sits. And given how volatile Nvidia can be, I think a break below 140 could see the share price head further down towards the 100 moving average at 133. The last few times when this moving average was tested, the share price rebounded quite quickly, showing how strong a support it is. But this also means if this level breaks, it's waterfall time. As for the bullish thesis, it's quite straightforward. We need to stay above that 23.6 Fibonacci level at 147 for a while longer. In fact, I think there is like an invisible resistance at around 149. So if Nvidia can close above both of these levels, then it could do what Meta did, which is to charge towards the all-time high and continues to run higher. Let's now jump over to the options trading section. Total 2 trades to update this week. The first one is this new cash secure put on Apple, which was sold on last Tuesday, 21st January. The strike price is 200 and the contract will expire on 28 February. So something happened on that day which made me step in for this trade, and that something is my favorite, which is overreaction from the market. If you had followed my channel long enough, you would know that I love to trade overreaction movement. I also shared this in one of my options videos. I have linked it at the top, check it out if you haven't. Anyway, what happened on 21st January was that Apple received double downgrades from Jefferies and Loop Capital, and to rub salt to the wound, JP Morgan slashed their target price for Apple as well. When this news came out, Apple gapped down at the opening and fell out of this bottom channel. This to me is an overreaction by the market. I have never trusted all these analyst upgrades and downgrades. Just to add on, prior to the gap down, Apple has already fallen from 260 to 220's range. With that gap down, Apple has declined about 15%, wiping out more than $580 billion of market cap. What I am trying to say here is that the share price has been very beaten down and the RSI was at the oversold area. This means a technical rebound was imminent. On top of this, we had that 200 moving average acting as a very strong support. With this in mind, I quickly stepped in to sell a put option, which is a slightly bullish move. Anyway, don't get me wrong, it doesn't mean Apple will suddenly become bullish and fly up again. A technical rebound can be a small bounce or sideways movement, and that's what exactly happened for the rest of the week. Apple had a little bounce the next day after I sold my put option, and then it moved sideways. With that, my trade is currently up by around 29%, and I can close this position anytime to take profits if I want. Okay, the next trade to update is this cash secure put on Nvidia, which expired last Friday, 24 January. This contract was sold on 19 December with a strike price of 110. The thought process behind this trade was straightforward, pretty similar to the earlier Apple trade. Basically, what happened back in November and December last year was that Nvidia has fallen from around 153 to roughly 127. That was a good 17% drop. Its 6-day RSI value was also hitting oversold area. With this, just like the earlier Apple's trade, I was of the view that a technical rebound was on the card. To add on to that, when I zoom out the chart, you will be able to see that the last 3 times when the 6-day RSI hit or went near to this level, Nvidia's price was higher 1 month later. True enough, Nvidia's share price was indeed higher roughly 1 month after I sold the put option. Right now, it's currently sitting at 140's range, and so this contract expired worthless last Friday, 24th January. Which means I got to keep the full premium again without having to close my position. Anyway, I have shared this trade transparently in one of my previous videos. I have linked that video at the top. Do check it out if you are interested to find out more. Okay, the second Trump era is here, and the Wall Street has largely celebrated Trump's second arrival to the White House with a nice rally. But in the weeks ahead, investors will be bracing for a series of policy updates from the Trump administration, together with a series of earnings results, key inflation and economic growth data, as well as the Fed meeting. The beginning of February is also seen as the possible start of Trump's tariffs, which investors will continue to monitor closely. Alright, personally, as I am heavily invested in tech stocks, I would want to know how companies are working with the Trump administration to ensure they don't end up on the wrong end of Trump's proposed tariffs policies. And even if you are not invested in the tech sector, I think it's also good to keep yourself updated on this news, as most of these mega cap tech companies belong to the top US companies, and when combined, they can move the stock market quite significantly. Whether you like it or not, President Trump will impact the tech's biggest trend in years to come, whether is it tougher tariffs, export controls, or more relaxed antitrust regulations. Again, whether you like it or not, Trump is going to move the stock market. Just to quote you an example, Trump has already made his mark on the AI scene last week by announcing Stargate, an AI data center company. OpenAI and Oracle will construct data centers to power AI projects within the US. As a result of this announcement, Oracle's stock popped 7% in a single day. Another example, Apple, whose CEO Tim Cook has a good relationship with the president, avoided tariffs during the first Trump administration. I believe Tim Cook will look to securing a similar arrangement this time round as well. Other mega-cap companies such as Amazon, Google, Meta, and Microsoft, which have faced significant challenges with antitrust issues and mergers and acquisitions regulations in the past, could stand to benefit if the Trump administration relaxes these rules. Specifically for Meta and Google, they will be interested to know what Trump has in store for TikTok. Both companies stand to gain users and advertising dollars if TikTok is banned in the US. But Trump is reportedly working with TikTok CEO to find a way to keep the app up and running, despite a law calling for it to go offline. In the event that Trump and TikTok couldn't find a solution, advertisers might have no place to turn to but to advertise on competing apps like Instagram and YouTube, which would be a solid good news for both Meta and Google. There's also the fate of the CHIPS Act. The legislation which was passed under Biden administration is meant to bring semiconductor manufacturing back to the US, but Trump has criticized the law, which provides billions of funding to chip makers, where they could use it to complete their ambitious plans, for instance, building new chip making facilities. But despite his criticism, the market is expecting Trump to continue this funding, and this will definitely be good news for your major chip players such as Nvidia, TSMC, Intel, Samsung, etc. All in all, for the entire year of 2025, it would be good for investors to stay informed and monitor key developments in Trump's policies, which will affect the US economy at large as well as individual corporate earnings. All these stuffs are intertwined and will dictate market trends for this year, at least. And to add on, throughout the year, we can expect higher than usual volatility as compared to Biden administration. Apart from the earlier example on Oracle, just to quote another one, last week, Trump said he would rather not impose tariffs on China, and this softer stance had eased some fears over a potential trade war. As a result, Chinese stocks popped after the remarks. This once again demonstrates the power of Trump's comments. And I believe such surprise remarks and comments that could move the market substantially will persist in the year ahead. It's definitely going to be an exciting year, and I am very much looking forward to it. How about you? What are your thoughts of Trump 2.0? Let me know in the comment section below. With that, I will see you in about 2 weeks' time. Don't forget to tap the like button before you exit, alright? Thank you.